It is very difficult to push interest rates down below zero because people can always hold currency instead. So if you try and offer them, for example, a minus 2% on their bank account, they will take their money all out of their bank account and hold it in notes and coins. When prices are going down and unemployment is as high as it is at the moment, you know that demand is too low to meet potential supply. So one has got to try and increase the level of demand, and one way of trying to do that is to lower interest rates to encourage investment and discourage saving. Insofar as you encourage borrowing and discourage saving, you will increase the overall demand within the economy, which will grow rather faster and return you to full employment and your inflation target. What determines people's preparedness to invest is the interest rate they think they're going to have to meet adjusted for how they think prices are going to move. So if you expect that what you're going to buy is going to go down in price, then you really have to have a negative nominal interest rate to encourage you to buy more of it. So what you need to do is you need to adjust real interest rates, and when prices are going down, you tend to get real interest rates moving higher as a result. And so you have to have nominal interest rates lower. In order to get rid of the zero lower bound, you actually have got to get rid of this option of holding currency. And that is really very, very difficult. You can go down below zero by possibly up to 1%, 50 basis points or 75 basis points, because holding masses of currency is rather unattractive. You've got to store it, you've got to make sure it's safe, and you've got to look after it, which you don't have to do if you're holding claims in a bank or claims in other kinds of securities. And we've all been so used to using currency all our lives that sort of using an electronic purse or something like that is going to really cause us quite a lot of problems. I think the main idea that is going to come out of today's discussions is going to get rid of all high denomination currencies and try and work only with relatively low value currencies, 10, 20 pounds, maybe up to $50, but not more, in order to make the costs of using and storing currency as a way of avoiding negative interest rates and deposits much less attractive. It wouldn't be too difficult simply to withdraw the high denomination notes, because us old people can operate as long as we're allowed to keep our £20 and £10 notes, and we can do without £50 or 500 euros or 500 Swiss francs. The unfortunate feature of today is that fiscal policy is also very constrained by the very high debt ratios we have and the expected very large deficits that are going to continue because so many people like me are going to be old, need a lot more medical expenses, and that means we're going to have to rely more on monetary policy. And particularly if we start from a relatively low base and run into another financial problem, we're going to be in real trouble unless we can lower interest rates into negative territory. And there is another advantage of getting rid of high denomination notes, which is the overwhelming use is for nefarious activities, either sort of the black economy, drugs and prostitution and what have you, or for tax evasions. When you are told that your gardener or somebody who's doing minor repairs in your house would actually much rather get paid in £50 notes, because a cheque is something for which there is a record, and £50 notes is something for which there is no record. So if you want to avoid taxation, you go for currency. And currency usage is not declining. It's actually going up in our economies at the moment, which is probably due to enhanced tax avoidance as tax rates have been increased.